55 this year, you are about to make a financial decision worth roughly 400,000 Singapore dollars in lifetime income, whether you realize it or not. Almost nobody explains it before it happens, and the stakes are incredibly high because once this decision is made, it cannot be undone. Let's look at what to do with 200,000 Singapore dollars outside your Central Provident Fund. Turning 55 is a massive milestone in the Singapore system, but it triggers an immediate structural shift in your accounts. This framework is built for two kinds of people: CPF policy veterans and first-timers alike. It doesn't matter how much homework you've done in the past because the math does not change. The stakes are simple. You are standing in front of a financial crossroads worth 400,000 Singapore dollars in lifetime income, and you need to understand the rules before you cross. Let's look at what happens automatically the moment you hit 55. The system executes a sweep to close your special account funds, and a portion of your ordinary account are automatically moved to form your new retirement account. This sweep stops exactly when you hit the full retirement sum, which for 2026 is 220,400 Singapore dollars. Any ordinary account money beyond that ceiling stays behind, earning the standard 2.5% interest rate. Now let's look at the part that does not happen automatically. This is the voluntary top-up. You have the option to manually add cash into your retirement account beyond the full retirement sum baseline, all the way up to the enhanced retirement sum. For 2026, the enhanced retirement sum ceiling is 440,800 Singapore dollars, which is exactly 2 times the full retirement sum. Thanks to a recent policy change shifting this from 3 times the basic retirement sum, more Singaporeans now have meaningful room to top up. This brings us to the real question you need to answer. You have cash sitting outside the system right now, perhaps in a brokerage account or a standard bank savings account. This is money that already left the Central Provident Fund system once before. Should some of that cash go back in permanently in exchange for a higher guaranteed income for the rest of your life? That is the core dilemma. Let's break down the forensic math. If you leave your retirement account at the standard full retirement sum, the CPF Life Standard Plan pays out approximately 1,780 Singapore dollars per month, starting from age 65. Annually, that gives you 21,360 Singapore dollars. This is a guaranteed lifetime income stream that is inflation-linked by policy. It does not depend on stock market volatility, corporate balance sheets, or a REIT's distribution cuts. It is a genuine sanctuary asset. What happens if we scale up to the enhanced retirement sum? Because the enhanced retirement sum is exactly twice the full retirement sum, we can project the shape of the decision. My estimate for the enhanced retirement sum level payout is approximately 3,560 Singapore dollars per month. That translates to an illustrative 42,720 Singapore dollars per year. Keep in mind, payouts are not perfectly linear, and this is an illustrative estimate, not an official estimator output. You must run your own actual numbers through the official CPF board calculator. When you look at the gap between the full retirement sum baseline and the enhanced retirement sum payout, the difference is roughly $1,780 a month, or $21,360 every single year. Over a 20-year horizon from age 65 to 85, that accumulates to an illustrative 427,000 Singapore dollars difference in total income received. And remember, because this is a lifetime annuity, if you live longer, that real difference grows even larger. This is truly one of the largest single financial decisions you will ever make. And let's be honest, doing nothing is a choice. The special account closure and the automatic full retirement sum sweep happen to you without lifting a finger. Because only the voluntary top-up requires you to take physical action, most people don't do it. This creates an illusion of neutrality. Inaction is not neutral, it is an active decision to keep your capital liquid and permanently exposed to market risk instead of locking in guaranteed lifetime cash flow. To evaluate this choice, I use a simple 2 buckets framework. Bucket 1 is locked safely inside the system, delivering a guaranteed return for life. Bucket 2 stays liquid outside, but it faces a strict yield hurdle of 4.7% before any asset earns a place in your retirement portfolio. This hurdle combines a 3.2% forensic floor, our sanctuary-grade cash baseline, with a 150 basis point risk premium because unlike the system, open markets can lose money. Turning to the Singapore stock market, let's look at dividend stocks and real estate investment trusts. For names that genuinely clear our 4.7% hurdle, the viable yield range sits between 4.5% and 6.5%. But look closely at the balance sheet screen. Gearing must be below 35% and the interest coverage ratio must be above 4 times. A high yield on a stretched balance sheet is not income, it is a warning sign with a distribution attached. What about Singapore savings bonds and treasury bills? We must know their place, The latest Treasury bill auction came in at 1.48%, well below our 4.7% hurdle rate. The current savings bond tranche offers a first-year rate of just 1.46%, which sits even below the ordinary account's 2.5% baseline. Savings bonds and Treasury bills are useful tools for short-term cash parking, but they fail completely as a core retirement income strategy. The supplemental retirement scheme offers clear tax advantages, but the exact same discipline applies to every single holding inside it. For income-focused holdings, your target yield range should be 4.7% to 5.5%. Remember the annual contribution cap of 15,300 Singapore dollars for citizens and permanent residents. A tax deferral is a nice benefit, but it does not excuse a weak underlying investment yield. Now let's address a hidden leak that most forensic discussions skip entirely: the entry cost. If you deploy 10,000 Singapore dollars into a local REIT and your broker eats up a meaningful chunk of that money in minimum commissions, you have started your position in the red. You are losing ground before a single distribution ever lands in your account. Entry costs directly degrade the real yield you receive from your liquid bucket. In the world of dividend investing, we spend a lot of time talking about the yield spread, the difference between what a stock pays you and the risk-free rate, but there is a hidden leak that most retail investors completely ignore: transaction friction. If you are deploying 10,000 Singapore dollars into a Singapore REIT and your broker eats a chunk of that in minimum commissions or platform fees, you are starting your investment in the red before you have even bought a single share. Data is only useful if you have the tools to act on it without getting eaten alive by those fees. That is why I use Longbridge. They are currently the only platform in Singapore offering lifetime zero commission circumflex for US, Hong Kong, and Singapore stocks. Their data visualization is also some of the fastest I have used, which is critical when you are timing an entry in a volatile market. To help you plug that leak, I have partnered with Longbridge on an exclusive arrangement for my viewers. For the first 10 readers who open and fund an account with a minimum of 10,000 Singapore dollars, Longbridge is offering a direct 100 Singapore dollar asterisk cash credit on top of their already generous June welcome rewards. Here is what the full package looks like if you deposit $10,000, hold it for 90 days, and complete 5 buy trades. You receive the exclusive $100 cash credit. You receive 300 Singapore dollars worth of NVIDIA fractional shares. You receive a 5% per annum interest boost coupon valid for 365 days on deposits up to $4,000 worth up to 200 Singapore dollars over the year. And you receive platform fee coupons worth up to 450 Singapore dollars across US, Hong Kong, and Singapore markets. All of these stacked together. You do not have to choose between them. Why does this math matter to a forensic investor? Because $100 on a $10,000 deposit is an immediate 1% day one yield boost before you have executed a single trade. Combined with the interest boost coupon hash and platform fee savings, the total welcome package meaningfully neutralizes transaction friction and protects your margin of safety from the moment you fund the account. This is strictly limited to the first 10 spots. The link and full terms are in the description. Other fees and terms and conditions apply, so read those carefully before you proceed. But for a forensic investor who cares about entry cost and yield from day one, this is worth 5 minutes of your time. To see how these two buckets interact, let's meet Tan, a heartland archetype. Tan is 55 years old and lives in a 4-room HDB flat in Bedok. His retirement account has just been automatically swept to the full retirement sum baseline of $220,400. Outside the system, he holds $200,000 in liquid capital and $15,300 in his SRS. The gap to reach the full enhanced retirement sum is exactly $220,400, meaning he is precisely one decision away from a full top-up. Let's weigh the two paths for Tan's $200,000 side by side. In scenario A, he stays liquid, deploying the capital across dividend stocks, savings bonds, and his SRS. His guaranteed monthly payout stays at the full retirement sum baseline of $1,780. In scenario B, he tops up towards the enhanced retirement sum, boosting his guaranteed monthly payout to an estimated $3,394. Scenario A gives him emergency liquidity, but exposes him to market volatility and distribution cuts. Scenario B locks the capital away permanently but completely neutralizes market risk. As you can see, neither answer is universal. A forensic framework can show you the mathematical layout, but it cannot see your personal health, your family's longevity, your other liquid reserves, or how much you personally value financial certainty over flexibility. What this framework can do is ensure you make a conscious choice with the real numbers right in front of you rather than blindly drifting into scenario A through pure inaction. This brings us to what I call the forensic tragedy of omission. The vast majority of retirees who end up in scenario A didn't actively choose it. They simply failed to act before their cohort's top-up window shifted, and the default became permanent by omission. Scenario A isn't inherently wrong, but the real tragedy is when someone who genuinely wanted the lifetime certainty of Scenario B discovers the door was open only years after it locked. This is a built-in feature of the system, but it only works if you know it exists. To run a reality check on any retirement plan, I use the SAN score, which stands for your sanctuary asset number. The rule is strict. Do your guaranteed and highly predictable income sources alone cover your baseline monthly expenses? We calculate this by aggregating your CPF life payout, your SRS drawdown plan, and your steady SGX dividend income, then measuring that total directly against your actual monthly living costs. Let's look at Tan's SN score under both paths, assuming his baseline monthly expenses are $3,500. In scenario A, his system payout, SRS drawdown, and an illustrative dividend income clearing the 4.7% hurdle give him a total of $3,838. He passes his baseline by $338. In scenario B, topping up boosts his system payout significantly, bringing his total monthly income to $4,669. He passes comfortably by $1,169. Let's take an honest reading of these results. The takeaway isn't just that scenario B passes by a wider margin. The real difference lies in the ongoing effort required. Scenario A's pass depends entirely on his stock and REIT portfolio clearing that 4.7% hurdle every single year through market crashes and distribution cuts. Scenario B's pass depends on absolutely nothing except being alive. Both are valid, but only one forces you to do forensic financial work for the rest of your life. Let's move into our broader strategic considerations, starting with the gap between the basic retirement sum and the full retirement sum. For 2026, the basic retirement sum sits at $110,200, exactly half the full retirement sum. My estimate for a basic retirement sum level monthly payout is roughly $890 compared to the $1,780 at full retirement sum. The gap between these two choices is closer to $890 a month than the smaller figures people quote. Always verify your cohort's numbers on the official calculator. Our second strategic consideration governs concentration risk at retirement. Whatever capital you choose to keep liquid outside the system must be screened against the 25% concentration rule. No single stock or single economic sector should ever hold more than a quarter of your liquid portfolio's total value. The natural temptation at this stage is to concentrate heavily into familiar local banks or blue chip REITs, right when your sequence of returns risk is at its absolute highest. Our third strategic consideration is to manually verify the operational mechanics. The top-up windows and deadlines that apply to your specific birth cohort change over time. This framework provides the forensic mindset and the financial logic required to think through the decision, but it does not replace direct verification with the source. You must confirm the current process directly with the CPF board before you act, not after. This brings us back to the core choice. The closure of your special account and the initial sweep into your retirement account already happened to you automatically. The question I want to leave you with is simple. Are you going to let the rest of your retirement strategy just happen to you by omission? Or are you going to step up and actively make the decision? I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and does not constitute investment advice or a recommendation to buy, sell, or otherwise engage with any investment products or financial services. The author is not a licensed financial advisor and is not offering financial advice. All views expressed are solely those of the author and do not necessarily reflect the views of Longbridge Singapore. All investments carry risks, may not be suitable for everyone, and you may lose your investment principal. Past performance is not indicative of future results. You should seek independent financial advice if you are unsure about any investment decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore.